and welcome to HAVE.crypto's YouTube channel, where you can find and learn everything about crypto markets and trading. In today's lesson, we continue with the second part of the video for candle patterns. So, take a comfortable seat and let's get started. In the last video, we reviewed different bullish and bearish formations, but actually, there are a few formations which can act in both directions. DOJI. When a market's open and close are almost at the same price point, the candlestick resembles a cross or plus sign. Traders should look out for a short to non-existent body with wicks of varying length. The DOJI pattern conveys a struggle between buyers and sellers that results in no net gain for either side. Alone, a DOJI is neutral signal, but it can be found in reversal patterns such as the bullish morning star and bearish evening star. Spinning top. The spinning top candlestick pattern has a short body centered between wicks of equal length. The pattern indicates indecision in the market, resulting in no meaningful change in price. The bulls sent the price higher, while the bears pushed it low again. Spinning tops are often interpreted as a period of consolidation or rest, following a significant uptrend or downtrend. On its own, the spinning top is a relatively benign signal, but they can be interpreted as a sign of things to come, as it signifies that the current market pressure is losing control. Head and shoulders pattern. Often considered the most steadfast of all major reversal patterns, the head and shoulders chart pattern is employed by novice and experienced traders alike to speculate on both stock and crypto markets. The benefit of this chart pattern is defined areas to set risk levels and profit targets. The inverse pattern is equally useful in any trader's arsenal and adopts the same approach as the traditional head and shoulders pattern. Enter a short when the neckline is broken. Your take profit area is obtained by measuring the distance between the head and the neckline and applying it to the neckline breaking point. The opposite comes when talking about the inverse head and shoulders and entering a long position. Before moving to the next complex formations, make sure to like this video, subscribe to our channel, and click on that notification bell. It's free. Triangle formations. Triangle patterns have three main variations and appear frequently in the crypto market. These patterns provide traders with greater insight into future price movement and the possible resumption of the current trend. However, not all triangle formations can be interpreted in the same way, which is why it is essential to understand each triangle pattern individually. Symmetrical triangle. The chart below shows the symmetrical triangle. The vertical distance between the upper and lower trend line can be measured and used to forecast the appropriate target once price has broken out of the symmetrical triangle. It's important to note that finding the perfect symmetrical triangle is extremely rare, and that traders should not be too hasty to invalidate imperfect patterns. Traders ought to understand that triangle analysis is less about finding the perfect pattern and more about understanding what the market is communicating through price action. Descending triangle. Below is a good example of the descending triangle pattern appearing on a crypto chart. A downtrend leads into the consolidation period where sellers outweigh buyers and slowly push price lower. A strong break of the lower trend line presents traders with an opportunity to go short. In this example, it doesn't take long for the position to move in the opposite direction, highlighting the importance of setting an appropriate stop level. The take profit level is set using the vertical distance measured at the beginning of the descending triangle information. Ascending triangle. An ascending triangle can be seen in the chart below. Leading on from the existing uptrend, there is a period of consolidation that forms the ascending triangle. Traders can once again measure the vertical distance at the beginning of the triangle formation and use it at the breakout to forecast the take profit level. In this example, a rather tight stop can be placed at the recent swing low to mitigate downside risk. Thank you for watching our video. Next time, we will continue with some tips and tricks about divergences and volume. Also, don't forget to check out HAVE.crypto.io and try our trading indicator. Subscribe and don't miss this opportunity.